Hey, you've probably heard the words index funds, mutual funds, hedge funds, or ETFs thrown around at dinner parties or on social media where everyone suddenly becomes a finance guru. But what are they really, and which one should you care about? Well, stick around, because in the next 5 minutes, I'm going to break them down in the simplest, most no-nonsense way possible. No Wall Street suits required. We're going to cover what exactly a fund is. Spoiler, it's not some secret club. Okay, hedge funds kind of are. The different types, how they're managed, the risks, fees, and strategies, and most importantly, who they're actually meant for. But first, let me slap on the classic disclaimer. This is not financial advice. I'm not your financial advisor, your Uncle Larry, or Warren Buffett's pen pal. This is purely for education and a dash of entertainment. What the heck is a fund anyway? Imagine you and your friends are throwing a birthday bash. Instead of one person footing the bill for the food, cake, and DJ who only plays ABBA remixes, everyone chips in a bit of cash. Now you've got a pooled budget that can handle the whole party without giving anyone a panic attack. That's exactly how a fund works. A bunch of people pool their money together, and that money is then used to invest in a mix of things like stocks, bonds, real estate, heck, maybe even fine art, if you're feeling fancy. Instead of you stressing over which stock to pick like it's the lottery, the fund does all the heavy lifting. You sit back, let the fund do its thing, and hopefully enjoy the ride. Index funds, the chill, lazy genius of the investment world. You've probably seen finance influencers shouting, just throw your cash into an index fund and forget about it, bro. But what does that even mean? An index fund is basically a copycat. It doesn't try to pick winners or losers. It just tracks an index, a fancy list of companies that represent a piece of the market. Think of an index as the scoreboard of the market. Like the S&P 500, that's an index of the 500 biggest companies in the US. If the S&P 500 goes up, it generally means the big dogs in the economy are doing okay. There's also the NASDAQ, home of tech legends like Apple, Microsoft, and Amazon, aka the companies that make your phone, your work software, and your online shopping addiction possible. You've got indexes for everything. Industrials, hello, Dow Jones, small companies, emerging markets, even niche sectors like healthcare or energy. Index funds just mimic these lists. No guessing, no fancy suits picking stocks while sipping macchiatos. They're passively managed. That's actually good news. It keeps fees laughably low. We're talking as low as 0.02%. That's like paying 20 cents on every $1,000 you invest. I bet you can't even buy a gumball for that. Big players in the index fund world, Vanguard, BlackRock, they run iShares, Fidelity. Low cost, low effort, and because you're spreading your money over hundreds of companies, relatively lower risk, assuming you're not expecting overnight riches. Quick heads up though, index funds don't trade like stocks. You can't buy or sell them at lunch break and expect instant action. They're only priced once per day, after markets close. So if you buy at 11 a.m., your actual buy price will be the one calculated at market close. No day trading action here, folks. Mutual funds, like index funds, but with a bossy manager. At first glance, mutual funds look like index funds. Slightly more ambitious cousin. They also pool money. They also invest in a basket of assets. But the key difference? Mutual funds are usually actively managed. That means there's a manager or a whole team trying to beat the market by picking the right stocks at the right time. Sounds impressive, right? Yeah, except most studies show they don't consistently beat the market, and they charge you more for the effort. Fees usually between 0.5% and 1.5%, sometimes even more. Still, some investors like mutual funds because they want access to certain sectors, countries, or asset types that index funds don't cover. And some people just believe in the magic touch of a fund manager. Big mutual fund providers, Vanguard, Fidelity, JP Morgan. And yep, just like index funds, mutual funds only execute trades at the end of the day. Place your order anytime, but the actual action happens after the market closes. No thrill of instant gratification here. Hedge funds, the VIP club for risk junkies. Now let's spice things up. Hedge funds. Sounds fancy, right? And mysterious. That's because they kind of are. The word hedge makes you think they're all about reducing risk. But in reality, hedge funds are more like financial daredevils chasing high returns using complex, sometimes bonkers strategies. They invest in everything. Stocks, real estate, currencies, derivatives, maybe even rare sneakers. Okay, probably not sneakers, but who knows these days. They use tactics like short selling, betting against companies, and leverage, borrowing money to invest even more money. It's a high-stakes game with potentially high rewards, but also high risks. This is why hedge funds are usually only open to accredited investors. You know, the people with swimming pools full of cash. And the fees? Oh boy. The famous 2 and 20 model. 2% annual fee just for showing up. 20% of profits if they make you money. Yep, it's as expensive as it sounds. Hedge funds go big or go home. And if they mess up, well, you could go home with a lot less than you started with. ETFs, the cool middle child of the investment family. Finally, let's talk ETFs. Exchange-traded funds. They're like the cool kid that took the best traits from index funds and stocks and mashed them together. Like stocks, you can buy and sell ETFs all day long, and you'll know the exact price you're getting. Like index funds, they pool investors' money and spread it across multiple assets, offering diversification. Most ETFs are passive passively managed and track an index, just like index funds. Fees? Super low, often between 0.03% and 0.75%. They're also super accessible. Most platforms let you buy ETFs with no commissions. And if you want to invest in the S&P 500, you can do it through an ETF as easily as you can with an index fund. So, what should you pick? For everyday folks like you and me, index funds or ETFs are usually the best picks. Low cost, easy to understand, and you get a nice broad mix of investments, perfect for long-term investing without the daily drama. Mutual funds? They might make sense if you trust a fund manager or want access to a niche area of the market. Hedge funds? Unless you're an ultra-wealthy adrenaline junkie, they're probably not for you. And that, my friends, is the crash course on funds, minus the boring finance textbook. If you found this helpful, hit that like button, subscribe for more money talk without the snooze fest, and check out the next video right here. You'll love it, promise. Thanks for watching, and I'll see you on the next one.